What is the issue here?
Like I do not understand. Included in the trade payables was bill payable of 3,000, which was met on maturity. Like, what does this mean? I do not understand. And then debentures of 50,000 were converted into equity shares. So like,
Okay. Only this two part or all of
no, no, no.
the portion?
And then I had doubt in the just a minute. Um, in the ninth question as well. Because those type I'm not able to understand. I did not understand properly. Like when I was doing them, I couldn't understand. Is it like
Which
the
question?
same thing as the question 7, or is it like
Question 7 and 8.
the question 7 I did, it was easy only. But 8 and 9 I couldn't understand, so I did not do.
8 and 9. Okay.
Yes.
And what about 10, 11, 12, 13?
13 my doubt was like for we're supposed to calculate current ratio and quick ratio. So like whatever comes in current assets and current liabilities, I'm supposed to add them and then take that right. And then I
Yes. First of all, you have to calculate current assets, then current liability, and then you have to calculate by dividing the current asset from the current liability. Again, with the quick ratio, we have to calculate liquid assets, then current liability is already calculated. So you just have to divide that.
okay.
Okay, so let's first complete the question number 8. Okay, so third A, not change the increase, decrease or not change the ratio included in the trade payable was bills payable of rupees 3,000, which was met on maturity. Okay, so quick ratio is 1:1. To explain, I have to take some example, obviously, but the answer I will tell you that there will be no change.
Okay.
Okay. Now, how? That I will explain. Let's say the quick ratio is 1:1. We can take the amount, let's say 2 lakh and 2 lakh. 2 lakh is our liquid assets and current liability is also 2 lakh. Okay.
Okay.
Okay. Now, we have
Wait
paid
a minute.
bills payable.
Just a minute. They sent me the link for the test.
Okay. What is the timing?
The time they gave me 4, so it's 4 here, and then they sent me a link at 6.
Right now?
Yeah, they sent me like 3, 4 minutes ago.
Just 1 minute. Let me confirm.
Okay.
Okay, I called her, but she didn't reply. So I sent her a message that she is with me in the class. So the class will end after 45 minutes. I think they will change the timing, or
They told me after 5 p.m., but I'm not free after 5 p.m. I have something else.
okay. So reply that.
Yeah, I told them about them. So I'm waiting for their reply. They've just seen my message.
Okay. So quick ratio is 1:1. Liquid asset is 2 lakh and current liabilities is 2 lakh. Now, if there is any bills payable, what is bills payable? It is a current liability. Yes.
Yes.
Okay. Bills payable. If you pay current liability of 3,000 by paying cash, so your current asset will also decrease by 3,000.
Wait, can
So
you repeat?
if you are paying your current liability in cash, then your current liability will decrease. You're paying the amount,
Yes.
and your current asset will also decrease because you are paying cash. Okay.
Okay.
Actually, cash is also liquid assets. So let's say this is liquid asset. So your liquid asset will decrease by 3,000. Your current liability will decrease by 3,000. So 197, 197. Is there any change in the ratio? If you divide liquid asset divided by current liability, then it will be 1:1, which is same.
Yes.
Did you get this? Hello.
Yes.
So is this clear to you?
Yes, it is clear to me.
Okay. The next one is div debenture of, okay. Actually, I think in this question you have problem due to this line included in the trade payable was bills payable. Yes.
Yes. Yes. Yes.
Okay. Because your answer, like I told you that you get this, so you told me yes, but your voice is again like uh, you are not clear with the thing. Okay, so trade payable, if you remember the financial statement, under current liabilities, there is one item called trade payable. Yes,
Yes.
if okay. Under trade payable, I told you there are two items which is included, which is creditors and bills payable.
Yes. Bills payment.
Okay. Now tell me, is there anything new written in the question? Bills payable is always included in trade payable. So that is written in the question. Included in the trade payable was bills payable of rupees 3,000, which was met on maturity, means the date on which it matured, we have paid the amount.
Wait, can you repeat what did you say?
I am saying that on, actually, you remember that bill has a term, time period, fixed time period. Yes.
Yes.
And let's say 1 month, 2 month, that you have to pay after 1 month, 2 month, 3 month. So after this completion of time, it is called that bill matured. It is the maturity of bill. Yes.
Yes.
Okay. Now, if bill matured, then we have paid the amount on the due date. So bill payable of rupees 3,000, which was met on maturity, means the amount of bill is paid. So it is a liability which is paid on the due date. So our cash will go, our bills payable will decrease by 3,000. So same decrease in current liability, same decrease in liquid asset. So that's why there is no change.
No change. Okay.
Understood? Now your answer is like, okay, now I get it. So
Yes.
yes. Next is debenture of rupees 50,000 were converted into equity shares. So debenture is long-term borrowing. Yes.
Yes. Yes.
Okay. Okay. So long-term borrowing has no impact on liquid ratio or current ratio.
Okay.
And if it is converted into equity share, then it will become part of shareholders fund. Again, shareholders fund has no impact on current ratio or liquid ratio.
Wait, what? Can you repeat? Actually, I'm facing a lot of net issues.
Okay. This is equity and liability side. Yes.
Yes.
First item is called shareholders fund. Do you remember the format? The whole format?
Yes, I
It is
remember the format.
okay. Then there is non-current liabilities. So debenture is part of this. And when you convert into equity share, then it will become a part of shareholders fund.
Okay.
Now, shareholders fund have no impact on current ratio or liquid ratio. Both of these ratio are related to current assets and current liability only. Yes.
Yes.
So non-current liability and shareholders fund have no impact. So
Okay.
if there is any change in these two, then there will be no impact, no change.
If there's change in shareholders fund and debentures
And non-current liability, yes,
and
debentures.
non-current, okay.
So that's why there will be no change in liquid ratio because these two are not part of current assets and current liabilities.
Okay.
Clear?
Yes.
Okay. Now question number 9. Which part? The first, use tools for rupees 2,000. Then second, insurance premium paid in advance. Third, sale of goods on credit rupees 3,000. Honored a bills payable of rupees 5,000 on maturity.
It's the fourth one again. Bill payable.
Honored a bill payable again of rupees 5,000 on maturity.
So will
But
it be like
here
same?
answer will be different.
Okay.
In that case, answer was different. Here, the answer will be different. This impact is same. There will be 5,000 decrease in bills payable, and there will be 5,000 decrease in current assets also, liquid assets also.
Okay.
But answer will change. Let me show you. Again, let's say the amount of liquid asset is 2 lakh and current
Okay.
liability is 2 lakh. You have paid bills payable, so 5,000 will be, sorry, actually no. The ratio is different. 0.8 is to 1. 0.8 it is. So it will be 1,60,000. How I have taken this amount, you understood this? Yes or no?
Did not.
No?
No.
Okay, let me change the amount. Then I think you'll understand. Actually, I ask you everything so that if any confusion in any part, because
Yes.
generally I assume the amount and I think that a student will understand, then that is the problem. So that's why I asked. Now you
Okay.
get this.
Yes. Yes.
0.8 is to 1. Yes.
Okay. Yes.
Okay.
No point.
So minus 5,000 here and minus 5,000 here because you are paying bills payable. So bills payable will decrease from current liability and you are paying from cash. So cash will decrease from liquid assets. Okay.
Okay.
5,000 it is? Yes, 5,000. Then the amount is 75,000 and 95,000. So 75,000 divided by 95,000 ratio will be, let me check. It is 0.78 is to 1. Can you see the impact? There is
Yes.
decrease in the
There's
ratio.
decrease.
Yes. So same situation we have taken because in that case, the ratio was equal. So that's
Oh.
why there was no change. And here it is 0.8 is to 1. That's why it changed.
Okay.
And if I change the amount a little bit more, then you will see the impact. See here. Uh, it is 8,000 now and it is 10,000. Then also the ratio will be same.
No.
8,000 divided by 10,000, 0.8 is to 1. Yes.
Yes. Okay.
Okay.
0.
Now minus 5,000 and minus 5,000. It will be 3,000
3,000.
liquid
Yes.
asset
And
and
yes.
5,000.
5,000.
So it will become 0.6 is to 1.
0.6. Yes.
So see, in the same situation, I have taken the different amount and the ratio changed more. But we don't have to like assume this in different situation. Whatever amount you will take, it will decrease little bit or more. It doesn't matter, but it will decrease. Okay.
Okay. Okay.
So this is your answer. The last one. Any other doubt you have in this?
No.
Okay, then we'll discuss today solvency ratio.
Okay.
Okay, if you have studied this, can you tell me the name of all the ratio that we discuss in solvency ratio?
Insolvency,
Yes.
debt to equity, then
Okay. One.
total asset to debt ratio,
Very good. Two.
uh, interest coverage ratio,
Three.
net asset turnover,
Debt asset turnover.
net asset turnover ratio. No, no, no,
No, that's
no, that is
not correct.
activity. Sorry, sorry. Oh my God. No, no, no.
Yes. There is two more, I think.
Yes, two more. Debt to debt to capital employed.
Yes. Debt to capital employed ratio. Four. One more.
Proprietary ratio.
Yes. Five. That is very good. You remember all the ratio. You're revising the concept. Yes.
Yes, because they're going to ask us the formulas and everything again.
Okay. That is very good. Actually,
Yes.
when we teach online, like in this class, so we ask the student, and generally the student ignores the question. But that is very good that you are giving the answer. You are interactive in the class. That is very good. Otherwise, like it is very boring. When I'm only speaking and I'm asked question, the student don't reply, then again I start teaching like this. If this happens, that is like very worrying.
No, I'm actually, for me, interacting online is really like really normal now because whenever I've taken tuitions, it's always from India. So like in 10th grade also, maths and all that, I used to take from India only. So I have this, or else I know the person teaching me will get bored and then like there'll be no, you know, like
Fun.
the child is not interacting, why will I interact? So it doesn't create a good pressure, what do you say?
Yes.
Yeah,
Impact.
impact, yes.
Like, yes, like we have studied impact on quick ratio.
Yes.
Okay, so solvency ratio, there is five, as you have already told me also. There is total five ratio. Now, what is the solvency ratio? That is the main thing here, that when we discuss solvency ratio, we have done the liquidity ratio. Liquidity ratio is very small part, very short term
Yes.
in nature. Okay, it only tell you about some basic thing about the business, but business will continue in the long run. Solvency ratio tell you this. So the solvency ratio is more important than this liquidity ratio. But yes, both are important to get the information about the company. But long-term purpose, if you think about this, then the solvency ratio will help you. Now, the if we go by the definition, solvency ratio means a ratio which will tell us about the ability of a firm to pay its long-term liabilities. That is called solvency ratio.
Okay.
These, right? These actually you have already written, I think.
Yes, I already have it.
Yes. Solvency ratio is used to evaluate the ability of firm to meet its long-term liabilities. Now there
Like
is
it's
first
supposed to
one.
meet it's like it's supposed to meet its long-term liabilities.
Yes, company will be able to pay its liabilities or not, because in some time, like if company is not doing good, he can fulfill his short term requirements, but not in long term. Okay. If you're not
Okay.
earning good, if you're not earning good, then for 1 or 2 months, you can carry your house, you can fulfill all the expenses by taking loan or money from friends. But if you don't earn money properly, then you'll not be able to run your family expenses for 1 or 2 years. It is as simple as that in the business also. So
Yes.
you can fulfill all your short-term needs in from different sources, but in long run, you need to earn money. Then only anyone will give you uh, the money, the borrowing you can make. So that's why
Okay.
solvency ratio is more important. Now, these are the ratio that we have to discuss here, debt equity ratio. First one is debt equity ratio. Now here, debt means not debtors. So don't get confused.
Okay.
So debt means long-term borrowing. So it shows the relationship between, actually it is already written, why I'm writing, debt to equity ratio. No, one item is missed here. Okay, it shows the relationship between long-term debt and shareholders fund. Equity means shareholders fund. So ratio debt equity ratio equals to long-term debt divided by shareholders fund. Long-term debt divided by shareholders fund. The ideal ratio for long-term debt is 2:1.
Okay.
Why 2:1? Because if you have your own funding, means investment done by you or the other owners of the company. So if you have invested 5 lakh into the company, then you can take loan of 10 lakh, up to 10 lakh. It is assumed good, but in today's time, companies do different things and they borrow money in very uh, heavy amount. You can say that you have invested only 1 lakh and you have taken 1 crore loan. That also happens, but that is not a good thing. Okay, whenever you borrow money
Okay.
and the future perspective is good, then only it will uh, perform well. Otherwise, it will not going to be good for your company. Just understand by one example. I am giving you the actually the original example in my area. Actually,
Okay.
there was a business, a shop, uh, ready-made garments and uh, other things like that. So they were doing good. They are earning 5 to 6 lakh per month. Okay,
Oh, wow.
actually, yes. So they were earning. This is the profit I'm talking about. So they were earning 5 lakh profit every month, and they have the borrowing of 50 lakh.
Oh my God. 50 lakh?
Yes, borrowing of 50 lakh, but his own capital is also 30 lakh invested
Okay.
in the business. So now you can see the difference is not very high. He have his own money 30 lakh
Yes.
and 50 lakh he has taken as the loan. Now 5 lakh profit into 12. In a year, he is earning 60 lakh. You can see the amount is very good.
Yes, it is.
Yes. So he can uh, pay this loan by using 1 year earning. Okay. But now he uh, gets greedy. Okay, and
Okay.
he increased this borrowing to 1 crore 50 lakh.
That's
So
a
he
lot.
thought, yes, he thought that yes, our earning is good, so we can pay it in 2.5 years, and our earning will also increase. But what happened? 1 year goes very well. Okay, he paid some of
Okay.
the liabilities also, and it becomes this. Okay, after that, lockdown came,
Oh,
the COVID time.
downfall.
And the problem is his shop was shut. Now, this earning, because shop is not uh, opening, so how you'll do the business? And if you have the employee, if you have the building on rent, then you have to pay the money. But one thing was good, that his building was not on rent; it is their own
Okay.
property, so they don't have to rent. Pay the rent. So, but a salary of employee they have to pay, and other expenses like interest on these amounts. They have taken very high interest borrowing. Okay, so when you take from bank
Okay.
on actually personal loan, it is 16%, 18%, but he has taken from local financiers. So the interest rate was 30, 35% in a year. So on
Oh,
this amount, every year he has to pay 36 lakh
okay.
as interest, only interest. And if your earning is not 60 lakh, not 60 lakh, what? You are not opening the shop. So it becomes, let's say, 5 lakh in a year. So 1 year goes very bad, and he was not able to pay this 36 lakh interest. So all of his lenders who has given the loan came to ask the money back, all of them. Okay, not all of them, but most of them came to get the money. Now, after payment from the capital and some of the savings that he made, he was able to pay only 50 lakh borrowings. Okay, so
Okay.
still there is a balance of 80 lakh. Now he has to sell some of his property. There was some case filed against him due to non-payment of loan,
Oh,
and he has to sell some of the property to settle the loan by little bit less amount. Some of them uh, take some less money and ignore the thing that he was not able to pay. So after selling one of the his most precious property, he was able to settle his dues, and then now he's back in the business. Now he's running the
okay.
business, but now his earning is only 50 to 60,000 per month
Oh,
because
I
the
that's sad.
business broke. So that is what happened when you take borrowing, which is very high. So that's why we suggest a small business that yes, you should take up to 2-3 times from your own capital, because you can use your capital or other savings to repay these borrowings. But if you increase the borrowing very much, then you will not be able to pay in bad times and your business will shut down. So this is the situation. This is why debt equity ratio is the ideal ratio is 2:1. Understood?
Yes.
Okay. Actually, I explained this. Let me ask you one question. When I asked from some of the students, they say that to the point topic is only enough. Sometimes I give example which takes time. Okay, so
Okay.
if you are only focusing on the exam point of view things, then I will not give you these examples, which will obviously waste some of our time, and we will continue with the topic. But
No,
there
but it
is
will make better.
yes. So what do you think? It is good or
It is good, like it'll make me understand. It's very interesting, honestly. In real life, examples are really nice. I like
oh,
such examples.
that's good. Okay, so this is the ideal ratio. Now, objective of debt equity ratio. Why we calculate debt equity ratio is to know that if there is something bad happens, then we will be able to pay from our equity or not. Is it safe for the lenders to give us the loan or not? So they will use this ratio. Okay. So
Okay.
this is our debt equity ratio. Please write this. Then I will write these two formula.
Okay.
Actually, you have theory. If you have already written these, then you don't have to write it.
I've already written these.
Okay. So what is long-term debt then? Long-term debt means long-term borrowing plus long-term
Long term.
provision.
Okay.
Long-term provision. Now there is two more item in long-term non-current liability. One was deferred tax liability and one was other non-current liabilities. Yes.
Yes.
So these two are not part of long-term debt. We only take long-term borrowing and long-term provision. Now in shareholders fund, in the formula, it is debt equity ratio. So equity doesn't mean equity share capital. It is shareholders fund. So we will include equity and preference share both. Equity share
Okay.
capital plus preferential capital, because one of the previous class when I have taken, one student started solving by using this equity share capital. He ignored preferential capital because the formula says equity. Preference share capital plus reserve and surplus. It is also part of shareholders fund. So
Yes.
this is the formula of shareholders fund. Now in reserve and surplus, we include security premium, then general reserve, capital reserve. There are various types of reserve that we include, and equity share capital. In this, we use paid up capital of equity shares, paid up capital of preference shares, and then other all the reserves we have. So this is shareholders.
Okay.
In long-term borrowing, there is loan, debentures, term loan, mortgage loan, whatever, long-term borrowing. So we write only those. Okay. So is there any doubt you have in this debt equity ratio?
No, not yet.
Okay. The second is total asset to debt ratio. Now, this is total asset to debt ratio. You can see total asset to debt ratio shows the relationship between total assets and long-term debt. Uh, it measures the safety margin available to the lender of long-term debt. Okay. So if we calculate like this, let's say long-term debt is long-term debt, for example, it is 1 lakh we have, and total assets we have, the value of total asset is 3 lakh. So whatever happens, our total asset is 3 times than the long-term liability. So what is the situation? It doesn't matter. We will be able to pay all these liabilities. Yes.
Yes.
Because if we sell all our assets, we can pay the this long-term debt 3 times. So that is good. If we sell any one portion of the assets, then also we will fulfill our liabilities, and that is what it is saying. It measures the safety margin available to lenders of the long-term debt. Okay, the formula is total asset to debt ratio, total assets divided by long-term debt. Actually, this is not much important part in the solvency ratio. The most important is debt equity ratio, then proprietary ratio, and interest coverage ratio. Debt to capital employed is a new ratio. It came, I think, 1 or 2 years before. It was not part of this solvency ratio. It only came 1 or 2 years before.
Okay.
So this is proprietary ratio now. After this formula, we will solve some question.
Okay.
Because quotient generally includes these 3 ratio. If we get separate quotient for all the ratio, then good. Otherwise, we have to solve at least these 3 ratio. It shows the relationship between proprietors fund and the total assets. The objective of proprietary ratio is to measure the proportion of total assets financed by proprietors or shareholders fund. So, generally, we assume that total asset of the firm, which include non-current and current. So let's say it is 5 lakhs. So we assume it comes from, some part of it comes from our own capital and some part of it comes from the borrowed funds that we take from bank or other financial institution or debenture. So some part of it came from long-term liabilities and some part of it from our own capital. So that's what we are trying to calculate, that what part of this total asset came from equity. So it will tell us about that, what part of it is coming from debt also. If we calculate this, then this will automatically calculate it. So if 60% from equity, then 40% from debt. If 50% from equity, then 50% from debt. So one is enough to know these. So proprietary ratio equals to shareholders fund divided by total assets. So if shareholder fund is 3 lakh and total asset is 5 lakh, it means 60% or 0.6 is to 1. 60% of total asset comes from equity. And 0.4, that is 40%, comes from debt. This is the
Okay.
main objective. Okay. Now let's solve some question if we have. Can you see the question?
Yes, I can.
This is not solvency ratio, it is done. $57, asking proprietary ratio, state with reason whether the proprietary ratio will improve. This type of question is very important. It is asked in current
Okay.
ratio, liquid ratio, and debt equity ratio also. Yes, here it is. From the following information, calculate proprietary ratio, debt to equity ratio, and total asset to debt ratio. So current assets is given, current liability, long-term borrowing, long-term provision, and non-current assets. So actually you have solved these type of questions, many questions, yes?
Yes, I have.
Can you try this or should I solve this one?
Can you solve it for me?
Yes,
And I'm
I,
so sorry for the background noise. That's my bird singing actually. I'm sorry.
okay, no issue. Actually, that is not very problematic. So
Okay.
it is not coming actually. Sometimes it is little bit.
Okay. Okay.
Okay, which bird do you have?
It's a cockatoo type, like the one which have like
I don't know the name also.
it's a very pretty bird. They're very interactive and they're not like the normal lovebirds. They're like they sing and all that. Like if you train them, they sing songs as well.
That's very good. हमने तो बस एक तोता सुना था कि वो बोलता है रिपीट करता है बातें.
The Mithu one, the green parrot. Yeah.
Yes, yes. Okay, from the following information, calculate proprietary ratio, debt to equity ratio, and total asset to debt ratio. Proprietary ratio, the formula. Can you tell me the formula?
Uh, Shareholders fund by total asset.
Shareholders fund divided by
Total asset.
First, we have to calculate total assets for this, and then shareholders fund also. Okay, total assets will be total of non-current assets and current assets.
Yes.
It is current assets 80 lakh and non-current 80 lakh. 80 lakh plus 80 lakh. It is 1 crore 60 lakh.
60. Yes.
Then there is shareholders fund. Shareholders fund, there is, okay. Shareholders fund, we have to calculate total assets minus non-current liabilities and current liabilities. Total assets minus non-current liabilities minus current liabilities. Now, this formula we have not written, but it is actually a common formula, you can say. If you see the balance sheet, yes, then on the liability side, there are 3 items. So if you remove 2 items, then you will get shareholders fund.
Okay.
So 1 crore 60 lakh minus non-current liabilities. It is long-term borrowing and long-term provision, 30 lakh, 50 lakh. So 30 lakh minus 50 lakh. And current liability is 40 lakh. So minus 40. Total will be 30, 50, 80, 120. So shareholders fund will be 40 lakh. Okay. Now, shareholders fund is 40 lakh and total asset is 1 crore 60 lakh. So total assets, only 25%, 0.25:1, only 25% of total asset is financed from shareholders fund. So balance 75% is from borrowing. Now the second ratio, debt to equity ratio. For debt, we need long-term debt.
By shareholders.
So long-term debt divided by long-term borrowing plus long-term provision. Long-term borrowing is 30 lakh.
Yes.
And long-term provision is 50 lakh. So total 80 lakh we have. Now debt equity ratio. The formula is long-term debt divided by shareholders fund. Long-term debt is 80 lakh and shareholders fund is 40 lakh.
Okay.
So it is 2:2.
2:1, yes.
Now after this, there is one more, total asset to debt ratio. Total asset to debt ratio, the formula. Actually, in every formula, you have to write the formula first, then the amount. Sometimes
Okay.
what we do is debt equity ratio equals to 80 lakh divided with 40 lakh, it will be 2 to 1. But they will deduct your marks for this.
Okay.
So total asset to debt ratio. Now total assets we have is 160. Total assets divided by long-term
By
debt.
long-term debt, yes.
160 divided by long-term debt is 80 lakh. Yes, 80 lakh it is. So it is 2 is to 1 again. Now, total asset to debt ratio 2 is to 1 is not good. Why it is not good? Because if anything happens, then your half of the assets will be sold for payment of long-term debt, and then I think your business is uh, not will be in operation because half of the asset will be sold. So how can you operate? So that's why you need at
Okay.
least 3 is to 1, 4 is to 1 type ratio in this total asset to debt ratio. That will be good.
Okay.
Okay. Okay. So you want to copy this or take the screenshot?
I'll take the screenshot. Then I'll have to join that test also.
Okay.
Can you scroll it down now?
So you open the Word file or something, and then you take a screenshot and paste there. Again, you take the screenshot and paste there. Or is there any other method you use?
I have the app sniping tool, so it's easily you can take the screenshot and then I copy paste into my like I'll copy paste it to my own self on WhatsApp. It's like that.
Yes. Okay. So tell me if you have any doubt now in any of these three ratio.
No, for now, no. You'll give the homework, right?
Yes,
Okay.
I will share the homework. So try some question, and if you have doubt, then we'll